The yellow metal has always glittered in India, one of the world's largest consumer of gold. But now the government is worried that India's gold fever is hurting the economy by weighing down India's current account deficit. This is the gap between export revenues and import payments. It widened to an all-time high of 5.4% of GDP or $22.3 billion during the July to September quarter. Crude oil is by far the biggest import item, but gold comes second. India's gold import bill amounted to $60 billion over the fiscal year ending March 2012, a sharp jump compared to $40 billion worth of imported gold the year before. To curb demand, the government is considering increasing import duty on gold from the current 4%. This step has been recommended by a panel from India's central bank. Experts, however, say that this won't help in a big way. The panel from India's central bank has also given new recommendations to regulate gold loan companies, which sit outside the normal banking sector, known as NBFCs, or non-banking finance companies. Firms dedicated to lending money against deposits of gold have been growing at more than 100% annually. The panel has called for an increase in the loan-to-value ratio, known as LTV, from 60% to 75%. For example, this would mean a customer could get a loan of $75 against a gold item worth $100 instead of the current norm of $60. This report is being viewed as a big positive for the sector, especially the non-banking finance firms, because they say it legitimizes their business. But at the same time, the Indian Central Bank is worried about their rapid growth, and that is why the panel has suggested some tough measures. For instance, if companies want to open more branches, they'll have to take prior permission from the Indian Central Bank. Now, experts say that if the report is implemented, it's really going to slow down the rapid pace at which these companies have grown over the last few years. For now, policymakers will be more worried about the current account deficit that continues to widen. Many economists feel that the government has to address its mounting fuel subsidy bill first in order to make any meaningful difference. But the big question remains, will the government bite the bullet and give priority to economics over popular politics?
Muthoot Finance is one of the country's largest gold loan companies with a market cap of $1.5 billion. Samir Hashmi caught up with the company's managing director, George Alexander, to understand the implications for the gold loan sector if India's central bank presses ahead with the report's recommendations.
In one sense, it is very positive. One word, it is positive. But I think you need to know a little bit about the background of why this committee was set up also. The gold loan sector is generally in the unorganized market. See, the NBFCs, the non-banking finance companies, have come to play an important role, and they have been able to transform this or convert this from an unorganized sector to an organized sector. So in the last 10-15 years, they have been doing well, and maybe in the last 6-7 years, they have been opening branches and growing at a very fast clip. When any sector grows very fast, any central government regulator needs to take a hard look as to why this is growing. Two things which clearly has come out from the report is that one, there is no systemic risk to the financial sector because of gold loan companies, and gold loan companies are not, or rather giving money on gold loan is not impacting the import of gold.
There's a suggestion that there should be a cap on the number of branches which the companies can open. And now you all have been growing at a rapid pace. Will that slow down the pace at which you have been expanding, especially in the rural areas? Because you would need prior permission before you can go ahead and open a branch.
Yeah, because the very basis of NBFCs, the advantage of NBFCs is the reach they have. If the reach is curtailed through restriction on number of branches, I think the purpose of the NBFC or gold loan NBFC is definitely hit. If the reach is curtailed, then what happens is the moneylenders, the unorganized sector will start raising their head once more.
Many are also saying that's going to impact the profitability. So would it be fair to say that this report, if implemented, is going to be short-term pain and long-term gain?
I think that is better put as it's a short-term pain and a long-term gain, because no business can work with a CAGR of 60%, 70%, 100%. These things, these regulations, these recommendations will put a brake on the high growth of 100%, but a 25 to 30% of the sector is certainly good and useful and more sustainable too.
If you still have to pinpoint some challenges for your sector, especially the non-banking companies, what are those, and if those can be addressed, it would really help the sector to grow even more?
See, after this report, what has really come out is that there were a lot of misconceptions about this business, gold loan business. People were not understanding the sector well. Now that the report has come out, and that too from a person connected with the RBI, or rather working in the RBI, it gives more credibility to the report. And all the misconceptions about gold loan has been removed. Of course, there are only some hygiene factors which all NBFCs have to adhere to in the long run. As you said earlier, short-term pain, long-term it will be definitely good for the sector.
Well, that's the end of this week's program, but do join us again next week when we'll be back with a fresh new look for the show. We'll also be making a special trip to one of the largest gatherings of humanity on earth, India's Kumbh Mela. I'm Shilpa Kannan in Delhi, and from everyone on the team, thanks for watching. Goodbye.